Assalamualaikum warahmatullahi wabarakatuh. My name is Nurul Aulia. Today I want to show you our research about error correction model's case of data inflation in Indonesia. Inflation was defined as an increase in the amount of money in circulation or an increase in liquidity in an economy. According to Atmaja, inflation in Indonesia was triggered by increase in the price of import commodities and swelling foreign debt, a result of depreciation of rupiah against the US dollar and other foreign currencies. The impact of exchange rate volatility can be seen from soaring product costs and causing the price of goods in Indonesia to increase. Consequently, to control the inflationary pressure, it is necessary to stabilize the rupiah's exchange rate against foreign currencies, especially US dollar, to determine whether or not there is a long-term and short-term relationship between inflation and the factors that are thought to influence inflation. A model is needed that is able to explain the effect of independent variable on dependent variable in long term and in the short term. Furthermore, the factors that are proven to have an effect on inflation in the short term and long term can be the government attention to control inflation. The model used is an error correction model. This study aims to apply an error correction model to inflation data in Indonesia. Next, materials and data. This research is an applied research that applies inflation data in Indonesia for the period of the first quarter of 2008 until the first quarter of 2019. The data used is secondary data from Seki Bank Indonesia, and the variable in this research is inflation, rupiah's exchange rate against US dollar, and interest rates. Result and discussion. Unit root test on variable. Stationarity of data was tested using the unit root test or ADF test. The result is shown on the slide. Table 1 shows that each variable is not stationary because the value of ADF test greater than the critical value of Mackinnon. Next, degree of integration test on data. Based on the ADF test, each variable is not stationary, so a degree of integration is carried out to determine how many different things that can make the variable are stationary. The result is shown on the slide. Each variable in the first difference is stationary because the ADF test value is less than Mackinnon's critical value, so the next step can be done. The next step is co-integration test. Co-integration test. To test the presence or absence of co-integration between the independent variable and dependent variable, it is done by estimating the parameters using the least square method, which is written as shown on the slide. We estimate the parameter of this model using least square, and we got this equation. Stationarity test of this model using ADF unit root test, and the result is this model stationary. Thus, the independent variable and dependent variable are co-integrated. Next, error correction model on inflation data in Indonesia. From the degree of integration test, each variable is stationary at the first difference, so that the short-term adjustment model can be written as shown on the slide. We estimate the parameter using least square, and we got this equation. So the error correction model for inflation data in Indonesia is as shown on the slide. The negative sign on the coefficient provides an explanation that inflation is above the equilibrium value, so that the inflation will decrease in the next period to correct the balance error. The coefficient which is negative and significant indicates the error correction model is valid. Next, classical assumption test error correction model. The error correction model must meet the four classical assumptions in order for the model to be used. The first is normality assumption. The normality assumption test was carried out by the Gerbera test. The result is as shown on the slide. It means that the error of model is normally distributed. The second is homoscedasticity assumption. Testing this assumption is done with the white test. The result is as shown on the slide. It means that there is no heteroscedasticity in the error. Thus, the assumption of homoscedasticity has been fulfilled. Next, non-autocorrelation assumption. Testing this assumption is done by using the BG test. The result of BG test as shown on the slide. It means there is no autocorrelation in the error. The result is as shown on the slide. Because its variable has a VIF value less than 10, the non-multicollinearity assumption is met. Thus, the error correction model satisfies four classical assumptions. Next, significant test of error correction parameters. The overall parameter test with the F-test aim to determine the overall significance of parameters in the error correction models. The result is as shown on the slide. Thus, there is at least one significant parameter in the error correction model. Therefore, a partial test was carried out with the t-test to determine the individual significant parameter in error correction model is as shown on the slide. Conclusion. Based on the result and discussion, it is concluded that the error correction model for inflation data in Indonesia is as shown on the slide. From this equation, we know that the rupiah's exchange rate against US dollar have no significant effect on change inflation in Indonesia in the first quarter of 2008 until the first quarter of 2019. While the interest rates have a significant effect on change inflation in Indonesia. The coefficient of determination is 41.98%, which means that change in the rupiah exchange rate against the US dollar and change in interest rate affect inflation change by 41.89%, while the remaining 58.11% is explained by other factors that not included in the model. Thanks for your attention. Wassalamualaikum warahmatullahi wabarakatuh.